The assignment in Chapter 9 Theory of Open Economy explain the market for loanable funds and the market for foreign exchange. The market for loanable funds is linked to the market for foreign currency exchange by net of foreign investment or NFI. The In the market of loanable funds, NFI is a portion of demand along with the private investment. In the market for foreign currency exchange, NFI is the source of supplies. The quantity of net foreign investment is negatively related to the real interest rate because when the Australian real interest rate is a high, Australian assets are more attractive and Australian NFI is a low. This is shown as a panel of the previous diagram. Number 2, explain the supply and demand and interest rate of the loanable funds. Where does it come from? So investment spending in more is an important category of real GDP. Not only is it usually the most volatile part of the real GDP, but investment spending physically capital is also on capital contributor to economic growth. So it's a firm wants to build a new factory. Where does it get the funds to build it? Usually firms borrow that money. The market for loanable funds describe how that borrowing happens. The supply of loanable funds is based on the saving. The demand for loanable funds is based on the borrowing. The interaction between the supply of saving and the demand for loans determines the real interest rate and how much is loaned out. Number 3, what will happen to the country economy if its trade policies are restrictive? So, trade protectionism is defined as a nation or sometimes a group of nations working in conjunction as the trade below, creating trade barriers with the specific goal of protecting its economic from the possible perils of international trading. This is the opposite of the free trade, in which a government allows a citizen to purchase goods and services from the other countries or to sell their goods and services to the other markets without any governmental restriction, interference, or hindrances. The objective of trade protectionism is to protect the nation and vital economic interests such as key industries, commodities, and employments of workers. Tariffs, which are tax on imports from the other countries and foreign markets. Here, the government imposing the tariff is looking to restrict imports of foreign goods and services, protect its own industries and companies manufacturing, such as item, and raise tax revenues. Quotas are a direct restriction of the number of the certain goods and products and commodities that may be permitted to be imported into the nation. This imports quota is generally enforced by the issuance as an import licenses to certain group of person or companies. Subsidies are government payments to domestic producers This can come in the form of cash payment, low to no interest loan, tax breaks, and government ownerships of common stock in domestic companies. Local content requirements may be imposed by the nation seeking to decrease imports by setting manufacturing requirement in which are stated as part of parts of the product must be made domestically. Administrative trades policies consist of new uh, bureaucratic rules, laws, and regulations designed to create serious difficulties for an importer of goods or commodities into a particular nation. Anti Anti-dumping policies are enact, enacted by the nation in order to prevent by to prevent the selling of goods in foreign markets at a price far below their production cost in order to give a substantial share of the nation market. Exchange rate controls can be used to make a nation and product cheaper abroad by lowering the value of its currency in the foreign exchange markets. Number 4, what is the capital flight? When a country experiences capital flight, what is the effect on its interest rate and exchange rate? Capital flights is a large and sudden movement of the funds out of money. Capital flight causes the interest rate to increase, the exchange rate to depreciate. According to Mankiw 2008, capital flight is defined as a large of the sudden reduction in the demand for the asset located in the country. Capital flight largest impact on the country from which the capital is fleeing. Mankiw 2008, when the capital flight occurs in foreign rates increase in domestic currency, depreciate, an interest rate reduces domestic investment, which shown economics grown depreciation of foreign makes exports cheaper but imports more expensive, pushing the trade balance toward the surplus. Number 5, what is the impact to local and international economy if fiscal policy will be implemented to buy only locally produced products? The effects of going local does not mean walling off the outside world. It means nurturing locally owned businesses which use local resources sustainably, employ local workers and decent wages, and serve a primary local consumer. It means becoming a more self-sufficient self sufficient and less dependent on export imports. Control moves from the boardrooms of the distance of corporation and back into the community where it belongs. Then the international use of government spending, the taxation of the influence the economy. Government typically use a fiscal policy to promote strong and sustainable growth and reduce poverty. In the lower term, the aim may be a foster sustainable growth. To reduce poverty, with action on the supply side, to improve infrastructure of education. Although these objectives are broadly shared across countries, the relative importance differs depending on the country circumstance. In the short terms, priorities may reflect the business cycle or response to the natural disaster or the spike in the global foods or flowing prices. In the larger term, in the driver can be development levels and demographics or natural resource in documents.